the profits they generate in a particular year. Out of that particular profits, they can share those profits with their shareholders. They can make a portion of payment of the profits to the shareholders, and the remaining can be retained for further operations of the company. So whatever are the typical payments that are being made to the shareholders, out of the profits that are generated, I can put them in the form of either dividends or the share repurchases. And what we see is they are one of the largest component as a part of the total return which is being expected by the investor. Probably I can look at it as the contribution of dividends as well as capital gains. So these two things put together is contributing to the total return of the investor. So understanding the dividend become more and more helpful from that particular dimension. Now, if at all I'm looking at the dividends, there are different forms of dividend. There are different ways in which the dividend can be paid to the various shareholders. One, it's a regular cash dividend which the company pays on a regular basis in the form of cash. Probably it could be quarterly or semi-annual or annual kind of a basis. On a regular basis, the payment is being made out of the profits of the company. And this should be more stable or increasing. The more it is stable or even if it is increasing, it can be visualized as a positive sign of the growth of the financial health of the company. But it can't be completely unpredictable kind of a number. This is a very stable amount that is being paid on a regular basis, and there is an expectation from the investor's perspective also that on this particular day we would be receiving at least this much in the form of dividend. So it can't be a fluctuating kind of an amount. It is more and more regular. It should be more and more stable or slightly increasing. If it is slightly increasing, it talks more and more about the positive signs in the growth of the company. Then there could be something called as either extra dividend, or sometimes we call it as a special dividend, or sometimes called as irregular dividend. Whatever is the name that is typically called as, this is one more form, especially when the company is having excess cash in one specific year. Probably they have done extraordinary business in an year and they want to distribute that excess profits in the form of cash to the shareholders just to keep them happy, right? So it should not be given as a part of regular dividend, because the moment it goes as a part of a regular dividend, the expectations for the next quarter, the next semi-annual years also will keep increasing. So this is like an extra dividend that comes up once in a while, especially when the company is able to do much better. Generally, this is being used very heavily by cyclical firms. Cyclical firms, their business is more and more going with peaks and troughs. In this kind of peak, when they have generated extreme profits, they'll try to make this extra or special kind of a dividend. And when they have when they are completely in this particular phase, when their profits are dying out, they can even retain paying the dividend. They can even refrain from paying the dividend which can still keep the confidence of the investors high, because they can still feel that this company will pay again when it is booming up. So this is one way that extra or irregular kind of dividends are being paid. As a part of the regular cash dividend, there could be something called as dividend reinvestment plans. Whatever whatever the dividend that the company is paying to the investor, to the shareholders can have an option to reinvest that dividend back into the company. That is what is called as a dividend reinvestment. On an automated way, there could be a mechanism wherein the dividend can be reinvested back into the company, which are called as dividend reinvestment plans. And whosoever have subscribed for that dividend reinvestment, either the company will issue additional shares for them, because they are contributing some more additional capital into the business. Their dividend, instead of taking it in the form of cash, they are giving it back, which means they need to be compensated with additional shares. So the company will issue new shares and distribute them to those who have opted the DRP. For all of them, at regular intervals, the company will issue new shares, or the company will buy back the existing shares from the market, buy back the existing shares from some of the existing shareholders, and give those shares to the DRP investors, so that there is no new number of shares that are getting increased. It's only the ownership change that is happening in the process. So for a regular cash dividend, instead of just talking about the cash and the receipt of cash, even there is a possibility of the dividend reinvestment as well. And coming to the other important aspect of dividend, one is called as a liquidating dividend. Especially it's looked at as a negative sign of the company when the company is declaring a liquidating dividend, because this is generally done when the company has going out of business. So it's either bankrupt, right, or it's going to shut down its business. And whenever it's planning to shut down, whatever are the proceeds that are there out of the business, or by selling the various assets of the business, they are the ones that are typically distributed to the shareholders. And this kind of dividend is called as liquidating dividend. Otherwise, it is typically treated as return of capital. So that's where whatever the taxation that is applicable to it, it is based on the capital gain. Whatever is the capital gain that was achieved, the tax on it, which gets treated as a capital gains tax, would be paid on the top of it. Then we can also look at the other form of dividend, which is stock dividend. This is one form of a dividend where the company does not pay cash. Rather, directly it pays additional shares to the investors. So no cash is being paid. It's they are given, every shareholder will be given some percentage additional shares. So generally it is quoted in the form of percentage. So whenever it is said, let's say 10% stock dividend, it means a person who is having 10 shares, he would be given one additional share, so making his total tally of shares to 11. So whenever we talk about a stock dividend, it is in the form of percentage, and it's only the, instead of cash being paid out, corresponding to the cash, additional shares would be paid, which means the cash would be retained with the company. So this would result in number of shares outstanding will typically go up. Nothing else might change, but the number of shares outstanding will typically go up, because for every existing share, some percentage of new shares are being created and issued, right? So in the stock dividend, we see that whenever a company has declared any kind of stock dividend, we see that the outstanding shares are typically going to go up, but the market value of the shares is not changing at all. It is more or less stable, because whatever the extent number of shares go up, number of shares are going up, the share price is going to come down accordingly. So which means the market value, which is the number of shares multiplied by the share price, that is going to stay stable itself, because no new activity is being performed by the company. It's only the number of shares that have gone up, which means per share price has to typically come down. And from a financial statements perspective, the retained earnings, typically are going to go down, because additional shares are issued out of the capital that is present in the retained earnings. Retained earnings are going to go down and share capital is going to go up by the same amount. So this is the typical adjustment that happens to the financial statement, which means only the equity components are typically changed and nothing else is happening here. So this is what happens in case of stock dividend. And just to understand the financial statement implications, as I said, one, market value does not change and number of shares are typically going up, which means the earnings per share is typically going to drop, because the number of shares are typically going up, the overall earning is not changing. The earnings per share is going to drop, and as I said, the stock price is also going to drop accordingly. But the overall wealth of the investor is not going to change in any way through the issue of stock dividend. Whereas when I look at any of the three methods which I discussed earlier, the regular cash or special or liquidating dividend, special or irregular kind of a dividend, or a liquidating dividend. What we see is, in all these three, there is a transfer of cash from company's accounts to the shareholders' accounts. So from a company's perspective, cash is down. Cash is down means current assets are down, and correspondingly the retained earnings are down. Current assets are down, retained earnings are down, so the overall total assets of the balance sheet is typically down. The total assets present in the balance sheet typically down, and because the retained earnings are down, you could very well see that the market price also should be down. Market price of the share should typically go down, right? Because the dividend has been declared, the market price of the share typically has to go down. Number of shares are not changing, so which means the total market value or the market capitalization is typically going to go down when there is a payment of cash from the company to its shareholders. Generally, we see that if a dividend of X dollars is being declared and the current share price of the company is Y dollars, what we could see is, after the declaration of the dividend, the share price of the company would be somewhere at around Y minus X kind of dollars. The reason being, the cash outflow happens in the company and the equity value will come down, because on the assets the cash is coming down and the equity is coming down, overall result in a fall in the market value of the company. So this is one thing with respect to regular cash or special dividend or liquidating. But when I look at it from the perspective of stock dividend, this kind of thing does not exist, because whatever are the additional shares that are created, that